Welcome back to our financial management course. Today, we will be talking about derivative products. Specifically, we will review what they are, different types, how are they traded, how are they used, why they are needed, and a few examples. Let's begin. Derivatives are financial instruments whose value is derived from the price of an underlying asset, such as stocks, bonds, interest rates, currencies, or commodities. They are essential tools for managing risk, speculating, and enhancing portfolio performance. Why they are called derivative products? They are called derivative products because their prices are derived from or depend on the price movements of another asset, known as the underlying. Let's look at some examples. A stock options value depends on the price of the stock. A wheat futures contract depends on the market price of wheat. A currency swap depends on the exchange rate between two currencies. There are several types of derivative products. Forwards. Private agreements between two parties to buy or sell an asset at a specified price on a future date. These are not traded on exchanges. Futures. Standardized contracts traded on organized exchanges, obligating parties to buy or sell an asset at a predetermined price and date. Swaps. Agreements to exchange future cash flows based on different financial variables, for example, interest rates or currencies. Options. Contracts that give the holder the right, but not the obligation, to buy, call option, or sell, put option, an asset at a specific price before a set expiration date. Where and how they are traded. Exchange-traded derivatives. These are traded on organized markets such as the Chicago Mercantile Exchange, CME, Intercontinental Exchange, IC, or CBOE. Futures and options are the most common examples. Over-the-counter derivatives, traded privately between financial institutions and clients. Examples include forwards, swaps, and customized options. Derivatives can be used for three main purposes: hedging, protecting against adverse price movements. For example, a farmer sells corn futures to lock in a price before harvest. Speculation, profiting from anticipated price changes. For example, a trader buys oil futures expecting oil prices to rise. Arbitrage, exploiting price differences in different markets. For example, buying gold in one market and selling equivalent futures in another. Why are derivatives needed? They allow investors to manage risk efficiently. They enhance liquidity in financial markets. They help firms stabilize cash flows and forecast future costs. They enable price discovery. Futures prices can signal expected future spot prices. Who uses and provides derivatives? Users, corporations, financial institutions, hedge funds, and individual investors. Traders, market makers, brokers, and speculators who facilitate liquidity. Providers, investment banks and specialized financial institutions design and sell OTC derivative products. Let's talk briefly about the brief history of the derivative products. The first organized futures market emerged in Japan during the 17th century, Osaka Rice Exchange. In 1848, the Chicago Board of Trade standardized futures trading for grains. Financial futures appeared in the 1970s for interest rates and currencies. Options markets developed in the 1970s with the founding of the Chicago Board Options Exchange and the Black-Scholes pricing model. Let's review an example. A U.S. exporter expects to receive $1 million in euros in 6 months. To avoid currency risk, the exporter enters a 6-month euro forward contract to sell euros for dollars at a fixed rate. This ensures predictable cash inflows regardless of exchange rate movements. In essence, derivative products provide flexibility and control in managing financial exposures, enhancing efficiency and stability in global markets. This concludes our discussion about what derivative products are. Mash, see you at the next lecture.